Hey, Don Luskin, there's a lot of talk about terrible profits. I'm just going to tell you, as of the close of business tonight, 145 companies, or 29% of the S&P, are reporting. Market-weighted are up 10.9%. Market cap-weighted profits are up 10.9%. I really don't see the gloom and doom, Don.
Larry, how can I begin to explain this to you? 10.9% just isn't good enough. As all the bears on your show are constantly explaining, if it's not 11%, it's a bear market. So forget about it.
You're right. Forget about it is right. And who does better, Jeremy? Traders or long-term investors?
Oh, yeah. I mean, definitely long-term investors. I mean, most traders, if you give into the moment and the emotion, you are absolutely going to do the wrong thing at the wrong time. And there's a very tiny few that are able to buck that common trend and succeed. So for the average person, boy, it's no contest. You want to be a long-term investor.
Don Luskin, long-term investor?
No question about it. You know, the great myth of trading is that it's the very few survivors in the trading game who show their face to the public,
yes,
who come on CNBC. What you don't see is that for every one of us, there are 10,000 who are driving cabs and flipping burgers somewhere.
Well, that's the thing. Now, you've been a great contributor to this program for many years now, and you have been a long-term investor. It's very interesting. I've watched your style. You get these blips, you get these worries, inflation, economy, profits, politics, tax threats in Washington. But through it all, you've had a remarkably consistent long-run positive view, and you have been right. How long do you take that positive view, Don?
Well, you stick with the model. You take it as long as the very few trustiest, most reliable indicators that you follow are telling you to stay invested. And when they turn the other way, you just face reality and you say, okay, we're in for duck and cover time. But I just don't see that. I agree with Dr. Siegel. I think you still want to be long stocks. It's still the long run.
All right, Michael Metz, your shot at this. Take a whack at this long-term investment.
Larry, I'm not going to weigh in against motherhood and virtue. Of course, long-term investing is wonderful. However, there are periods when an indexing strategy just doesn't work. If you had indexed in 1966, you would have only earned a 4% average dividend for the next 16 years. There are times when you really have to be careful about sector and stock selection. I think that's the time that we're in right now.
Jeremy Siegel, I don't have your book in front of me. I'm just thinking back. Michael said 1966. Now, how would 66 all the way out to 2007 look? Do you have any sense of that?
Oh, I mean, if you're going to go out to 2007 from them, you're going to get very near the long-run average there. Yeah, 66 was a temporary peak, and you know, through that, that was the beginning of the beginning of the big inflation period for 15 years.
Right.
You know, that was bad policy. Double-digit inflation. As soon as we got that under control, we reversed all the negatives from there. So I would say you are very close to an average. Had even bought at that period now, going ahead a good you know, 40 years.
Do you think?
But you know, if you do go back to the 60s, and let's say you had a crystal ball and you said in 1966, oh, this is 10 years when I don't want to be in index funds, you still would have had a very hard time picking the active managers who were going to do any better than the index.
Right.
Sure, the promise of ideal active management is great, but what's the reality? The reality is that it doesn't deliver.
And not only that, I mean, stocks didn't do great, but bonds did much worse. So I mean, there was a few choices that did well, but there weren't many.
And markets, I think markets, I mean, that was a terrible period, the stagflation period, but markets punished politicians and central bankers until they got it right. That's the part I like. If you have economic freedom, you have free markets, then markets will punish these guys.
And you have economic freedom to have a disastrous situation like we have now, with people gorging on leverage. You have a huge abuses of the whole economic system and financial system. Yeah, free markets are great when they work.
Well,
they work.
All right, are we going to get through this, Don Luskin? What's your take? We do have a mini credit crunch. I guess Mike thinks it's more of a maxi credit crunch. He's not alone. There are others who are very pessimistic on this. Will we get through this period?
Sure, we'll get through it, but let's be clear about what got us into this. This wasn't free markets. This was the Fed. This was a government agency that for years printed too much money and dropped it out of too many helicopters, and people did what you do when you find free money on the street. They lend it to anyone who will borrow it at any interest rate. And now the Fed's solving that problem by printing even more money and dropping it out of even more helicopters.
Well,
great. Yeah, we're going to get through it.
The more money part may be subject to debate, but I want to ask you, what about my recent thought? It is time to revive King Dollar. Why can't we protect the U.S. dollar? Does the Fed have to cut interest rates? Could we have a surprise move by the Treasury? A Rubenesque move. Not a lot of intervention, just enough to tell those short dollar sellers that there's a two-sided market. What do you think, Don?
We don't have enough reserves to do it.
That stuff's just never worked. Have George Soros on the show and tell him how he broke the Bank of England when they tried that kind of thing. You can't get there from here.
You can't. But don't you want to see a stronger dollar? I thought you were my hard money man.
I want to see a stable dollar. I don't want to see a rising dollar. I just want it to stick relative to gold, relative to other currencies, relative to oil. I just want stability. Isn't that the Fed's mandate? Price stability?